Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, February 4th, 2019. In this video, I want to take a look at the technology sector and about top dozen or so holdings within the tech sector. I'll start out here with XLK. Now, what we're going to focus on are just the long-term charts. We'll look at the weekly and monthly charts of XLK, and more so the top, like I said, dozen or so. Actually, we'll go down to 15 stocks, cover from Microsoft all the way down to NVIDIA. I'm doing this sorting those by market cap. Microsoft being the largest right now in the tech sector, and largest actually, I believe, the largest in the tech sector in XLK here, about 800 billion. Now, the reason I want to do that is as much, if not more, to get an idea where the broad market is currently at, from a technical perspective and where it's headed. And the reason for that is XLK, or the tech sector, I should say, is about a 20% weighting in the S&P 500. Now keep in mind there's only 11 sectors in the S&P 500. So you have from just the top heavy weighted sector here, you have about 1/5 of the return of the S&P 500 again coming from that top sector out of 11 sectors. So that shows you how top heavy the stock market is, the economy is with these tech companies. And then when you look at the NASDAQ 100, you're talking nearly 2/3, roughly about 60% being from tech stocks. So undoubtedly, if we can see or determine, use the charts to help figure where tech is going, we'll have a good idea where the market is going. Now, if you remember the site back leading up to the top back in last fall, early October. So I repeatedly harped on the fact for weeks, if not months, heading up to the top that the market breaks when tech breaks, and unless tech breaks, the market wouldn't break. And this is the wedge I was looking at. This was our golden trend line at the time. We had this uptrend line off the lows right here. We had this wedge with a divergent high, and then once tech broke, the market broke. Again, you can just overlay these charts. XLK will look nearly identical to QQQ, again, because of that, roughly 60% or so tech weighting in QQQ. So let's dive into the charts here. And when I do this, I just want to say this. I will do this as unbiased as I can. I'm going to go through and point out any current or potential bullish things that I see in the chart, as well as bearish developments or technical posture, if you will, and also some key levels to watch. So we can, if I don't revisit this, video and do an update in another, let's say, month or so, you can replicate these charts on your own and keep an eye on some things because we're really looking at longer term trend indicators and developments that are more accurate or more useful, if you will, for your long-term positioning and bias. In other words, they're not anything I go through today in these charts aren't going to give you any entries or exits for swing trade targets, short-term trades, anything like that. Again, because we're focused on long-term charts. Other than this daily chart here, I just wanted to point out. So before I move off this daily chart, since this is the sector itself, this is XLK. What are we looking at here? Well, we're up to the key 200-day moving average right now. We hit it today for the first time in XLK. We have a very significant resistance level coming up overhead at the $68 level. We had some reactions there, not a whole lot, but there's a nice reaction there. A couple there before you had a sharp drop after that support level broke. Came in back tested, failed, came back up. This looks like about 3 candles right there, about 3 days of reactions on that line. Finally broke out, and that was bullish. So we remained above that level for pretty much the better part of 2018. Came in for a near back test, but we had started to develop this uptrend line. And then you can see, tested it there, gave it up, quickly recovered it, danced on it for a while, and then you can see, barring just one little day, that was, if you recall, we had that pop above the 200-day moving average on the QQQ. That was it for just one day, and the next day we sold off impulsively, never looked back. So there's enough reactions in there, and call it around 68, give or take, as well as that 200-day. So same story with the markets. Yes, they're up today, but they're facing a mountain of resistance. And again, this sector now, for the first time today, has hit the 200-day moving average. So let's go look at the weekly chart and then monthly, and we'll go on to the individual components. All right, this is a weekly chart XLK. If I don't mention, what I'll do from here on out, I'll stick with just the weekly time frames, and then we'll go to the monthly. Actually, I'm going to start out on the monthly when we get to the individual stocks. But on the weekly chart of XLK, you can see this to me looks like a very clean technicals, very clean trend lines on this chart. In other words, some securities trade better to technicals than others, is what I'm trying to say here. And XLK, or at least the sector as a whole here, because that is an entire sector ETF, had done a good job. You can see what these lines mark up above are the divergence lines, periods of negative divergence. You can see it all down below on both the PPO right here and the RSI, and each and every one of those divergent highs without fail resulted in a correction. And let's just kind of give you an eye on the range, and remember this as well, that these corrections were um, some of them measured technically into bear markets, but we're not going to get tied up in the whole semantics thing, a drop of 20% or more, because drops of 20% or more in tech companies is run of the mill. So I'm going to consider anything we look at on the weekly chart, anything since 2009, simply being a correction within an ongoing bull market. So you can see they were ranged from about 8% at least, and this is again since the bull market started back in '09, to about a nearly 30% drop in the tech sector. And most recently, we had close to that as well, about a 23 or so percent drop. Okay, so bearish. Well, we broke the trend line and had a pulsive move down that showed that trend and that rising wedge pattern here was a multi-year uptrend line, was valid. That gave us that correction, and we also took out the 200-day, which has done a good job of defining the uptrend, and now we're back testing it from below. So resistance once broken becomes support. That's TA 101. Doesn't mean we can't get up above it. I'll show you again pros and cons of each as we go down. Let's now look at the PPO. PPO, one of my favorite trend indicators is the 9 EMA, the signal line on the PPO. You can use it on multiple time frames. Here we're using it on the weekly. And essentially when it's above the zero line, it tells you the trend is bullish and you want to be long. When it's below, as it was right there, it said the trend is bearish. It may not look like much, but that is certainly a tradable correction. That's probably 12, 15% or more, maybe even a 20% drop if I measured it out. And then, of course, that zero line, because it's a trend indicator, it also acts as support and resistance when tested from above or below. So you can see throughout the last decade, and that's what we're looking at here, 10 years of price history, there were only a couple times where it crossed below, and these weren't whipsaw signals neither. They caught or indicated drops of usually about 10% or more. And right now, what's different this time? Well, not only are we below it, but we're well below it. These were, again, what I consider to be corrections in an ongoing bull market, even though quite a few of those measured 20% or more. This still appears to me very indicative of early stage bear market action with the first bear market rally, with more to come, especially how deep below the zero line it took down that 9 EMA, that signal line. We haven't seen that again, nothing even remotely close since this bull market began back in 2009. So you'd have to go back to '08 to see that. Positives, well, if this is a correction within an ongoing bull with new highs to come, then you want to buy with both fists. And again, you did want to buy, like I said, back here, it was a buying op, no doubt about that, late January. But the question is it a buying op for the next 1 to 2 years? We haven't seen XLK hit that 30 level, which is oversold, the blue line on the RSI. Really since back in '08. Right here we had a near hit, and let's look here. I probably had it back at the bottom in '09. Here it is, yeah, March of '09. There, but you also had what you don't have this time around on XLK and many other stocks back in at the bottom at the lows in '09. You had the bullish divergence there, and that's what I like to see to position for a major trend change. So again, a lot of evidence here on the weekly points to XLK having more downside to come, especially right now we're back testing that resistance. Monthly chart. What stands out to me here? Well, we're going to focus a lot on this monthly chart. We're just going to look at three things really, maybe four. If there's some trend lines to be had, and I can probably draw one here for you. I should have had that already up there for you. Let's just go like this. Let's give it the benefit of the doubt, and let's use this off the '09 lows. So let's just say right now that tech is, and again, I told you I would give you anything that I could. If I see something in here that's potentially bullish, I would point it out. So I'm drawing this trend line and showing you that XLK, again, the most important sector in the market by far, came and made a successful test of this trend line. Last time we tested it, there were several hits back here. And remember, when you're trading candlesticks and drawing trend lines, it's not about these wicks or shadows, the tails, the long part. Sometimes you'll slice through there. There was a mini crash back here in 15, but for the most part, you want to see you draw a trend line with the most amount of bodies and or candlestick shadows at touch. So I think this is a pretty valid trend line here. We might be able to even tighten it up there and capture all the bodies at this point and let those wicks, which are intra-month moves, but again, it's about how you close a month. So right now, you can say either way I draw it, you have the tech sector still above trend and basically making a successful test of that trend line there. So that's check one for the bulls. The other thing we're going to look at here, and I covered this in some recent videos, one of my favorite long-term trend indicators. Again, I don't. You can go to yearly charts, quarterly charts that show each candlestick being 1 year price action or a quarter, but I go out. I like to just go out to about the monthlies. Again, we're going back into the 90s right here, so this is plenty of time to cover. So it's a very simple yet effective trend indicator. And as I often say, and you'll notice this as we go through the video, trend indicators work best, as the name implies, in a trending market when you have a sideways consolidation period in any security. You can use, most trend indicators won't work, but at least you'll have to go to a different trend indicator, set of trend indicators, usually faster moving ones. So here you had many years. This was, again, you can see here, 2004 all the way to, about 2009, really, where you just had a tech sector. It was in a slight uptrend, but very choppy and sideways. So what I want to point out is that the trend indicators work best. And if this line would have continued, it looks something like this. This was the dot-com bubble back here. So you had a few bulls and a few bear markets. There was a bull market leading up to 2000, the dot-com bubble. That was the end of that bear market that followed. There was a bull market up, as we all know, into 2007, October 2007 highs. This was the Great Recession right here. It doesn't look like much because this is such a large move. This is the only bull market in history that resembles this one is the one leading up to the 2000 and 2000 highs, both in time and in scope and in the amount the gains. So that's it. And you can see during the bear market, we were traded below that 20 period EMA. And for the most part, we had some choppy sideways action. It didn't do the best job. There were a couple whipsaws, but although if you measured these, I guarantee they were all 10+% corrections. But for the most part, you can see how well it contained prices. And again, I'm just picking some of the worst periods and telling you that no indicator is perfect. So you just have to pay attention on when to use them or put a little more weighting into them and when not to. But there's the top in 2007 right here. A big red candle took it out. That's what made it different from these others. We were limping around, chopping around. This time we went through it. And what I wanted to point out here is you can see that we came up and we recovered it after. Remember, this was the first leg down in the last bear market. This was the first bear market rally. We took it back. We took back the 50-day, the 200-day, and a lot of other things. But we had one monthly candle close above. You can see it right there, a green candle. And then boom. This is the dreaded wave 3 down for Elliott wavers. There's your wave 4, and then the bottom came. Wave 3 is the strongest wave in a 5-wave primary trend. All right, so that's that. After that, you can see we recovered it. These are long-term trend indicators. They're not going to get you out at the top, and they're not going to get you in exactly at the bottom, but they help define the bigger picture. So besides this run being so long in the tooth, you can see that once a bull market started back in '09, and once we recovered that back in '09 later on after the bottom was in, It's done a great job. And again, you have volatility, you have these intra-month pierces through, but each of these candles here closed, that one might have closed right on or just below, but you had candlestick closes. A green one means we closed up here, and it's done just a great job of defining the trend. You can see it there. Tested, 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 tested with the trend line. So there we are. So one thing you want to watch, this is for your long-term money, your long-term views of the market. Let's see what happens here. Remember, we did pop back above and regained it after an impulsive start. And so when I have this red box here, that price action back then looks very similar to what we're seeing right here. And as I said before we even started this bear market rally, it would be convincing, it would be impulsive, and bear market rallies are fun to trade, they're profitable to trade, and they end just when, at least the first one, that return to normal phase on the chart that I showed you before, and the cycles of a bear market. So we'll see what happens there. So let's move on down to the RSI. I don't have a PPO on this chart. We're going to keep these indicators simple. Well, there's only been a few times going back for decades here again that we were so oversold on the RSI. You can see red 70 level is considered overbought, I should say, not oversold, overbought. So right here, top of the dot-com bubble, beginning of that vicious bear market that followed. There's the 2007 bear market, most of the 07 to 09 bear market, as we know, one of the worst in history too, as this one was. And we had this one here. There was tech certainly had its own bear market by far. You can measure from high to low. This was a drop, you can see there, about 28%. So with a zero failure rate so far. Now, the thing about overbought, and I say this a lot, overbought in itself is not a sell signal. Why? Because overbought can either become more overbought or it can stay overbought for an extended period of time, which, as you can see, it very much has this time around. We became overbought here, stayed above. So what I like to use, and it's not 100%, but it's the best guide you have to knowing when to short or get out of overbought, is when you have an extended overbought reading, it's that cross back down below the 70 level that I like to use as a sell signal, the time to get out. So you can see here we crossed back down, flirted with it, back tested it from below, and then that was pretty much marked the top there in 2015. There was your cross down there. It would have told you to get out of the bear market back here in 2000, or out of the bull market, that is, long before it was a bear market if you sold back then, and pretty much the same thing back in the dot-com bubble if you were trading back then. So by all accounts that I've seen so far, other than this trend line breaking, with a solid, we did have a close below. Now we've regained it. So by most metrics that I'm looking at here so far, it tells me XLK is most likely in the very early stages of a bear market. And then finally, and as I go through the other charts here, guys, it won't take as long because I've explained how I'm using each of these indicators. So here's that ROC 12 I use. Sometimes I'll change it to an ROC 13, rate of change. And you can see it does a great job of defining primary trends, the big bull and bear markets. And I talked about this trend indicator in recent videos. It's not perfect, but it does a pretty good job, especially when you scrub it with some other indicators, some other trend indicators. What I mean by scrubbing it is if you get a red bar here, do your other trend indicators at the time confirm? Again, I don't have them all up on this one. That was covered in other videos. But again, as I said in those previous videos, these weren't whipsaw signals. This was its own bear market in corrections of 10% or more, and I just showed you about almost 30% there. So it's done a pretty darn good job. And what I like to do, instead of trying to zero in on each little crossover like this one or that one, I like to just look at the flow, the ebb and flow. As we all know, just take a very simplistic approach to the stock market or any security. Everything moves in cycles and waves. These are trends, bull and bear markets, and sure, there's micro trends within, but these are the bigger trends. So when I look down at a long-term trend indicator like this, I take a pretty simple view to it. I look at how the ROC, as the name implies, is a rate of change indicator, and I'm using a histogram. You can see it heading down. So before it even crossed, you could see we were losing momentum. And then when the bear market was going on, you can see it coming up. And even at this point, before it had crossed, you could see that was clearly where it was going. And so it didn't get you out of the bear market exactly at the bottom and into the next bull market, but you could have seen that it was headed that way. So I look for these hills, if you will. And then there are times, as I mentioned, you have these periods of choppy sideways market. That's when trend indicators don't do a good job. And you can also see here visually, the hills are low, if you will. The hills are what I call these, inverted hills or big hills here. So you want to stay away from that because it's not going to give, it will tend to give you more whipsaw signals. But here's a clean, this is the bull market from '07 to '09, the end of '07 to '09. And it just did a perfect job without any green bars of defining that. And since then, it's done a phenomenal job of saying we're in a long bull market here. There were a couple cross downs below, and again, that was in itself a bear market. There was a bear market there in tech. And so now what are we looking at? Not one, not two, but three consecutive, although we're in February now. Let's just say two consecutive because we haven't closed the month. This bar won't finalize until the end of February right here. But you can see two bars back to back. There weren't any bars remotely close, even though we had that choppy sideways 2-year market back here in 2015, 2016. These are pretty clear signals is what I'm trying to say. And again, they may prove to be whipsaw signals, but usually, if this, if taken in context, is I guess what I'm trying to say. With everything else that I covered above, when do bear markets end? Well, here's where they end. They end when you are oversold, when these charts have played out, all the technicals. We're not even close. Look at the RSI. We're right in the middle of the area there. So we've had that first kickback rally. Again, this was a 2007 high, and then we had the rally in early 2008, kicked the RSI back up, and then it took the next leg down. So that's what would really, and that wouldn't, I don't think that'll come for at least a year from now, but that would most likely indicate, hey, maybe it's time to get in for a multi-month, 6 to 12-month plus swing trade on these stocks if and when we get there. But we're a long ways from there because we haven't even given up this line with conviction yet. All right, now we're going to go through the components a lot faster. I spent, the bulk of this video talking about how I use these trend indicators. So we're on the monthly chart. And here's the watch list or the components of XLK, I'm sorry, Tech ETF. You can see right here, they're sorted by market capitalization. If I have time, I'll go down. I'll stop at NVIDIA. I want to go there because it covers these two semis. And the semis are one of my favorite sectors for the next bear market to put a multi-month swing trade on. In fact, we already have a trade that we just entered on those. All right, so Microsoft. Long-term trends, here's trend lines, extreme. Remember the dot-com bubble, as far as technology, was insane, overbought for a very long period of time. So let's not focus too much on that, but let's just look at these trend indicators. And Microsoft was a dead money stock for many years, dead money all through this period. It traded sideways for, what is that, well over a decade. So again, trend indicators like this 20 period monthly average right here work great in trending markets. Did a excellent job of defining the bull market. Told you right here on that big red candle, get out. You're in a bear market. Did a great job of keeping you short. And then we're in a sideways market. But this has been a trending market, right, from here to here. So we're above that, and you can see that we kissed it recently on the correction. And so there, I will give points to Microsoft as far as this goes for check points on the bullish side. At least we're above that 20 period monthly average. Let's watch it. However, we've taken out this trend line here. I think this is a pretty clean trend line. And what you're going to get in this video is some contradicting evidence, if you will, technical evidence. Bearish breakdowns of trend lines, but yet some key monthly averages, and they're all relevant. So they all go into building the case. What's the takeaway from that? Well, you'll have a huge check mark to get out and be out if you're not already out of your 401k, that type of money, or I had a lot of questions last quarter. Randy, if this is a new bear market, why don't I just buy all the short, 3 times short ETFs on the index and tuck them away? Nope, too early. And now you know why. And that rally that we've seen since the December 24th lows is exactly why you would have almost certainly been stopped out. And if you weren't stopped out, you would have wished you would have been. So you got to get the timing right on this. And we don't have the all-in yet for short the market and throw away the key for 6+ months. That's not here yet. It could be soon. We have a lot of early indications and a lot of indications that look like it's headed that way. But this would be another one. Take out on a solid monthly close, big red candle down through that 20-month on Microsoft. There's the cross down below the 70 level on the RSI. There's another check mark for the bears. And although we don't have our trend indicator here, remember, Microsoft has been one of the strongest of the FANG stocks, but you can see this big hill forming, and you see where that appears to be going. Again, after a big, extreme high like we had back here, we've seen this is actually more powerful than we had back here in leading up to the dot-com bubble, and you can see where it went there after it tapered off and crossed down below. There was a bear market. All right, so we'll go a little faster here. Apple. Let's see here. You have the trend line right there. You can see here's all the bear markets for the past, going back to '08, the percentage drops that we've had. And again, I would consider these corrections within an ongoing primary bull market. That was actually, by the time that one was done, it was 34% drop and 39% drop. Those were measured off the divergent highs, by the way. Those with the arrows marked. You'll see that on the weekly chart in a minute. But you can see trend lines, and there's that 20-month EMA right there. And Apple has crossed below it. Apple, of all companies out there, and that was the world's largest company up until not too long ago, by every metric that I have, Apple is in a bear market. There's no mistakes about it. Now, is that bear market? Could it be over? Certainly. Only time will tell if the roughly 39% drop off the highs we had was it. But right now, we're coming in, we're back testing that key 20 period monthly average from below. That should act as resistance. It should contain it if this is the first counter trend rally in a new bear market. The PPO or the RSI crossed down below the 70 level and has yet to hit that oversold level. Although we never really did on Apple going back here. So that here, sometimes I'll look at a stock and I'll have to put a different line. So 30 is typically oversold on the RSI, but Apple kind of, this is what's contained their pullbacks in recent years, called around the 43-ish level. Came close, but not exactly there. And then you can see clearly that the ROC 12 is signaling the first bear market since back here, and that was a powerful. And that one lasted. It wasn't huge in percentage terms, about 35%, but it lasted for a long time. 45% bear market, 62% bear market, with zero failure rate on this ROC 12. So, that's all. Trading, that's all we can do. I cannot promise you that this is a new bear market with a lot more to come, but I go by certain things, and that's why I'm doing this video. So there's some stocks that look better than others, but others that clearly appear by many metrics to be in the early stages of a bear market. And again, that's the point of this video. Here's Visa. Yes, this one's actually part of XLK in the tech sector. Here's that. It's been trading publicly under that ticker since 2008. And that 20 period at EMA has done just a great job. Started out trading here, had a couple monthly candles. That was also sideways trading action. So again, you didn't have really a trend to work with there. But since then, once it started working its way up in a very clear uptrend, it's watch, rinse, repeat, buy back, buy on pullbacks to that level. So far, that level held. So that tells me a couple things. Well, number one, it's above trend by that trend indicator. And number two, that unmistakably is an important level, because this is not mere coincidence, all these tags here. You have too many tags. The more tags of a support level that are successfully defended, the more valid that support level is. Doesn't mean I can guarantee 100% that if it breaks and prints a monthly close, that it's going to go down 30, 40, 50% or more. I can just tell you with a high degree of confidence, I think that it will. Whatever else we see here, Again, not a lot of history, but you can see the ROC 12 turning down. But again, we can only go back to '08 on Visa. So let's look at a couple more. MA is partner in crime. Go back to 2006. Trend line here. I tried to draw a trend line. I don't want to force this. It's the best I could do, the best fit. Maybe we can extend it out. Yeah, let's extend this one out here. That does a good job. There were a lot of reactions there. So we'll say this one, MasterCard has caught both the trend line support and the 20-month, which has also done a good job of defining the uptrend. So those are levels to watch, and that's part of what I'm doing in this video. If you want to replicate these charts, 2-3 months from now, 3 weeks from now, whenever it is, you want to go and check where these are. The more check boxes you have, breakdowns, and especially on monthly closes below these levels, the greater the chance is that we are now in a bear market. And if we continue to move on up, we take out the highs, and what happens? And on those that have broken down, if they start to recover those levels, like the 20-week moving average and trend lines, then that tells you that, you know what, a few stocks entered or triggered some long-term sell signals, but some others didn't. And so if those that did break down can recover and start moving up, then hey, maybe this was another buying op like it was in the past. So like I said, you can look at this glass half empty or glass half full. INTC, Intel, there's Intel has just been a dead money stock for many years, or was back here from long-term perspective. This was sideways trading, but we did have, just like we had an uptrend here into the 2000, the dot-com bubble highs, and that uptrend was done a pretty well job of that 20-month capturing that uptrend. Big red candle down through it, told you you're in a bear market. And then we tested it once, failed. But then this is where it was choppy, where I just highlighted here in that purple line. However, we've had since about '09, we've had a pretty consistent and steady uptrend. So it's more of a price channel, if you will. This is what I'm focusing on now. So since we've had that uptrend, as we zoom in, the 20 hasn't done a great job. I'm not going to force it. If it doesn't do a good job on some stocks, then let's just not put a heavy weighting on it. That's how I look at it that way. So I'm not giving the 20-month EMA a big weighting here. I am giving that trend line a higher weighting. There's a pretty significant support level, and time permitting, I'll get to the weekly charts here in a second. Choppy stock, not one of the best to use as an example because of that multi-year big sideways trading range there. Cisco, there's our uptrend line. 20 has been chopped through quite a bit. This is a lot of these old school big tech companies, I'd say old school because they've been around for a couple decades. They're mature companies. Companies go through a life cycle process, and from a startup to a strong growing company, and then finally mature. And that's what's happened with a lot of these big techs. So with those, you're not going to have a lot to take away from these trend indicators I'm using, because the charts, you don't have these clear trends like you did. Cisco was a powerhouse back in the 90s, and then had a bear market, and then really has been mostly dead money since. However, the one thing I would take away is a well-defined uptrend line off the looks like the 2011 lows maybe. So we'll watch that trend line. Oracle, it's the best fit I could put on a trend line there. Again, another not a phenomenal growth story, but a pretty steady climber since 2002. More of a steady eddy, and again, more of a mature tech company than anything else. Trend indicator is bearish, and again, you have to measure out. You look down here, the ROC 12. I'm sorry, guys. ROC 12 is in. Remember, don't pay attention to the most recent bar, because this is a monthly chart, and we just started February. So it's, by all accounts, it's red. Last month was January, December. So this one's been on a sell signal, at least by this ROC 12, since going back to June, the end of June, or the June, candle. All right, so we'll watch that trend line there. IBM, looking better than most, divergence on the monthly chart, but the ROC 12 is telling you it's in a bear market, which obviously it is. You can see from the highs there. I'll turn these off, show you. IBM peaked back here. This is Big Blue, one of the former leading tech companies, peaked all the way back there years ago, and has been in its own bear market. Unmistakable, 50% bear market sense. So make no mistake about it. From a long-term perspective, here's a trend which has been down. 50% drop. However, it looks better than most again from this chart. So, if you're looking for individual names, this is one I'd probably go, well, at least from this chart. I'm not telling you to go long yet. I'd have to look at the weeklies and everything else. It's below that 20 period. You can see that clearly below it now. And that's about that. Adobe, let's turn back these indicators. Potential trend line there. Adobe's been trending above that 20 period monthly average. Done a good job so far, and we're still above it. So check marks to Adobe. Although this is headed down, this trend indicator down here, the ROC 12, is still green. But we did have an extreme overbought reading, and we recently had a cross down below that 70 level after being extremely overbought for an extended period of time, just like we were back leading up to the dot-com bust, and then there was our crossover. CRM, Salesforce.com, recently crossed down below the 70 level on the RSI, kind of testing it now. The ROC 12 is still bullish, still above trend and above the 20-month. So there's one that you can't write off yet. It's still solidly in a bull market from this longest term indicator. AVGO is Broadcom, crossed down below the 70 level here. The crosshairs still well below. Trend indicators were firing. Last month we had a green bar and it hit support and it's above the 20. So this one doesn't look so bad from a long-term perspective. PayPal, let's see. PayPal hasn't really traded very long on a monthly chart. We only go back to 2015, so we can't really take much from that. ACN, Accenture, there's a nice uptrend line to draw. Big red candle down through it, so that's bearish. Went popped down below the 20, which has done a good job. Again, that 20-month EMA has done a great job throughout the bull market off the 09 lows since it recovered it of defining the uptrend. We sliced below it. Pretty much closed on it last month. We're trading above it now, but again, we're in February, early February, so we'll have to see how we close the month here. RSI was overbought, went below zero. All the ROC 12 trend indicator is bearish, clearly bearish, not like these little whipsaws back here. Big red bars similar to the last bear markets in this one. TXN, Texas Instruments, there's a primary trend line. This is a well-defined trend line. I put a high weighting on this trend line because it does a good job of containing the prices. 20 gets chopped through a little bit, so I'm not putting a big weighting on that. RSI was overbought. Trend indicators are bearish, but again, this one needs to break that level. That trend line, that is. NVIDIA, this looks just bearish all across the board. The tech, so remember, the tech sector is very cyclical and has big swings. And I remain longer term. I think there's more meat on the bone on a tech sector short than just about any other sector out there. When the tech sector breaks, that's it. The cycles are big. You can see them here. You can see well-defined uptrend lines. We had an uptrend line here. That trend line's not very well defined. So what we'll have to do is put a bigger weighting here on the 20-month EMA. You can see it's done a great job. Bear market here, we crossed down below it, stayed below it, it was resistance. Then we crossed above it and it acted as support. The trend was up. It wasn't a very powerful uptrend, but that was an uptrend, not a sideways trend. And it did just a bang up job of telling you that the trend was up and bullish. And here it broke down clearly and we're below it now. It looks to be flagging here on the monthly chart. We did hit oversold, but remember, just like overbought can become a lot more overbought, oversold can become more oversold or stay oversold for an extended period of time, especially during a bear market. The ROC 12 is unmistakably bearish right now, clearly red, and that's NVIDIA. Okay, guys, I had all intentions to cover the weeklies too. Just went too long. There was too much to cover in the video. Spent the better part of the beginning of the video explaining, how I use each trend indicator, and then I kind of rolled through a little quicker. But it's hard for me to gauge how long these things will take. But this one hit my limits, so we're going to stop here. And if anything stands out on the weeklies, I'll send that. So again, long-term stuff here. stuff to watch for. I'll, if I do a follow-up to this video, it won't be for at least a few weeks to the end of this month, because we won't really have any changes on these monthly candles until, the beginning of March. So we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.